Can you describe your typical working day?
My typical working day is I come in, I would say on any given day I will have about 3 to 4 meetings, and those meetings typically can be either internal meetings, which is for management purposes, that we have to make a strategic decision or we have to decide whether to launch a new product, which in our case will be a new investment fund, so for a combination of strategies. And then can be decisions about recruiting new people, what we have to do. And then there will be other internal meetings that are more research specific. So on any given day, I will probably have a couple of research meetings with some of my researchers to get updates on what it is that they're looking at and give them feedback and suggestions. And then I will have, say, not every day, but often some meetings with existing clients or prospective clients. And then in between, I'm a free man, so I can decide to read papers, given what I do, obviously, trying to keep up with recent research, whether it is academic research or what we call practitioners research. And so try to stay on top of what is going on in my area. You were saying, how is this life different from what I did before? I would say I can think about a few different stages in my life. First, when I was a PhD student, which meant being in the library basically my whole life. But that was exciting because I felt I was learning new things. And then when I became an academic, where I really enjoyed the idea of doing research, because of course that's one of the main reasons why I studied and I wanted to be an academic. But I will say I was also, and this is going to sound crazy, but a bit unusual because I really love teaching. And so a lot of people know that there is a lot of pressure when you're an academic to publish. And so there's always this perception, well, don't spend too much time preparing your lectures because you should do your research. For me, I really always enjoyed being with students, mostly I would say because I always felt, well, I've been so lucky to have the opportunity to learn these things, and how can I make them exciting to other people? If you think about it, what I studied is a lot of statistics, econometrics. So I would say the bar is pretty high. To get young people excited about this is not easy. They'd rather do something else. And so for me, it was always a great pleasure when I actually could get the students engaged and see them say, oh, wow, you can actually enjoy statistics. I'm a weird guy. I'm now almost 60, and I still love the idea of using statistics to evaluate what people say, and as an economist, especially coming from Chicago, one thing that I learned, questioning everything. People will make a statement and you'll say, okay, interesting, let me think about it. And then what does the evidence say? And I think that's an incredibly exciting aspect of life. If you can live most of your life, professional life, thinking that every day you're learning, and the tools that you learned in school are essential to really learn what it is that you're trying to learn and to try to find answers, I think you can be super happy. I feel that having been so lucky that I had the opportunity to do what I did really gave me an opportunity to see what an exciting career can be like, as opposed to you take a job because it pays the bills and you survive. I think that everybody should look forward to having an exciting career.
Is there a chance you could give some maybe example of what you do during the day?
Piece of research that I did a while ago, to be fair, but has been one of the essential aspects of the way we do research here at Kepos is, and I'll try to simplify as much as possible, okay, is this idea, as I was saying before, we're quants. So as quants, the biggest challenge that we get from people who are not quantitative, by quants I mean quantitative, the challenge that we get is people say, well, you think you can learn from historical data, and yet historical data are just a very specific sequence of events. If you think about it, if you look at what happened in financial markets, you have, say, the crash of 87, the LTCM crisis, you had the Russian debt crisis, you had 2 Asian currency crises, the tech bubble, and so on and so forth, right? So the problem with trying to develop strategies that learn, that are focused on those specific events, is that you could fool yourself into thinking, okay, look, if I executed those specific trades during that period of time over that sequence of events, I could have made money, right? But then, of course, somebody, and rightly so, would tell me, well, but the next sequence of events is not going to be the same as the one that you saw there. So how do you convince yourself that you're really learning something useful? So sometimes I give people an example in trying to trade what I call, say, a signal or an idea in currency markets. So I know this is, for young people, this is a bit complicated, but let me try to explain.
Sure.
So you can actually, as an investor, you live in the US, but you can buy currencies from other countries, right? So you can say, okay, I'm going to sell some of my dollars and I'm going to buy euros, or I can sell some of my dollars, I'm going to buy yen. Or vice versa. I have some yen, I want to sell those yen and buy dollars instead, and so on, right? So now if you're a quantitative manager, what you will do is say, okay, suppose I can every single day, I can buy any of 20 different currencies relative to the dollar, or I can sell them. How do we decide which ones to buy and which ones to sell on any given day? Well, what we do as quantitative managers will say, let's try to come up with some signals, we call them signals, that will tell us, well, these are the currencies that are more likely to appreciate going forward, and these are the ones that are more likely to depreciate. So I would like to buy the ones that appreciate, the ones that depreciate. So the next question is, well, how? That's really tough to forecast. I mean, I wish I could do that really, really well, right? Well, but you can try to learn historically if there is any information that you have today that can help you identify some of the currencies that are more likely to appreciate, right? So, for instance, one thing that people will say is that interest rates are useful indication of currencies that are going to go up or down. So if I compare interest rates across different countries, and I'll say countries where interest rates are a bit higher usually end up having in the short term currencies that appreciate, and vice versa. So here's one thing that you can do is say, okay, let's get together on any given day. Let's say I have 10 currencies. Let me find the interest rate in each one of those 10 countries. And then I rank them. I say, okay, this is number one, this is number two, right? And then I can build, and again, I don't want to be too complicated. I can build a portfolio where I say, I'm going to buy the 5 currencies that are associated with the 5 highest rates. I'm going to sell the currencies that are associated with the lowest interest rates. And suppose I do this every single day, and I have 20 years worth of data. Let's see if that strategy makes money. But here is the challenge. Remember I was saying, people will say, yeah, but now you're testing it over data that are from the past, right? So what we will do, we'll say, fair, that is true. But what if I do this? Okay, I take that history that I saw, I'm going to tweak it a little bit. I'm going to create 100 little variations of that history where I will say, okay, the first variation, maybe I never saw one of the Asian currency crises. But instead I saw the crash twice, the 87 crash. And then I'm going to have instead another variation of history where instead of 2 Asian currency crises, I saw 4 Asian currency crises, and so on and so forth. Remember, now I have these 100 variations of histories. And what I can do now, I can say, okay, given the idea that I had originally to invest using interest rates, how consistent are these results when I produce these different histories? I know this may sound crazy to you, but I think these are exciting ways of using statistical methods to verify what I would call, we use the term robustness In other words, how consistent are my results? Because I know that the future is not going to be the same as the past. And now, by the way, I made it simple. I said, let's use interest rates, but any economist will tell you, oh, what do you mean by interest rates? You mean 1 month? You mean 3 months forward? And those are all valid ideas, but my point is, that's the exciting, I know it sounds crazy, but that's the exciting part of this job, that you say, fair, those are all fair questions. Let me show you how I actually can try to find the answer to this, whether the 3-month forward is better than maybe the slope of the interest rate, the term structure, and so on.
Can you say 3 things that you love the most about your current job?
Well, I definitely love the research aspects, or the challenges of the research aspects. I studied for my PhD in Chicago, so I often joke that, Chicago is the school with rational expectations and market efficiencies were the prevailing ideas when I went to school there. So if I think about it now that I ended up doing what I do, I feel like, oh, maybe they'll take my PhD away. But the reality is, I think that what I did there, I learned some very powerful tools. I learned how to think. And so that makes it really fun for me to do research. The fact that I question what we do every day is actually fun. In fact, I will say I got into this job thinking, okay, it is going to be very, very hard to find anything that makes money. And that's because of my background. I got to believe that if there is a good opportunity, everybody's going to try to jump into that opportunity, and prices will go back to what perfectly efficient market will command. On the other hand, when people hear that I'm a Chicago guy, they'll joke, they say, oh, you're one of those guys that they'll never pick up a $20 bill from the sidewalk because it can't possibly be there. And my answer is, no. I have an amended version to that, which is, I will pick it up. I will just know that it's very, very difficult to find a lot of $20 bills. So I don't plan on becoming super successful just sitting on the sidewalk and hoping that there is a $20 bill. You have to work really hard to find those opportunities. So that's one thing that I like. Ironically, so when people ask me, what do I miss the most from my academic days? Sometimes I say I used to enjoy teaching and now I don't teach. But I will say I really like interactions with our investors, because once again, my feeling is that, especially if you're a quantitative investor like we are, manager as we are, investors are somewhat skeptical because they feel like, well, these guys use all this fancy math and I can't really get a good insight into what they do. And I feel that it is my responsibility to make them comfortable. In other words, you can distinguish the details of the math or the statistical tool from the philosophy of what you do, the idea behind the strategy. And I think that's fascinating, because once again, it's this idea of sharing your thoughts with somebody and making them comfortable and essentially making them feel like, okay, this is really interesting. I never thought about it in those terms. So
your best feelings of accomplishments and feeling proud of what you do are when you are figuring out the truth, where your research is one part, and second, you help others to figure out and maybe shape their opinions in a new way that they realize that they might be wrong.
I would say that's a fair description. With my amended version is that I know I will never feel that I found the truth. Far from that, but I would say that in working with a lot of noisy data, at least I feel I'm learning something. And then yes, the other side of the story is to share that information with others. Not the secrets of what I do, because of course that's how I make a living, but definitely share the way we think and why we think this is powerful, why this is useful. To me, that is a very exciting aspect of this profession. I remember that when I started working as a quant back in 1998, the systematic approach, the quantitative approach, was not as popular as it is now. So the biggest challenge was to go in front of investors who definitely were very, very skeptical. And, they would say, oh, I don't need somebody who is going to talk to me about stochastic differential equations. And that's not what we really do, but definitely there was a lot of skepticism. But then our role was to try to get investors comfortable with, no, listen, this is not about math. This is about, again, putting discipline into what you do.
So earlier in 90s, it was more like we just not looking at the history as much and just deciding.
It was definitely not a very common approach to be systematic. There were a few people, but the vast majority were
How did they do decisions? Just
discretionary. A lot. Listen, to be fair, still now, there are many investors who are much more comfortable with the discretionary approach, where, in our field, for instance, in what we call macro investing, people will say, no, I want to talk to the expert who tells me, listen, given the recent policy of the Fed, I expect rates to go this way, therefore I would suggest for now to go long, say, 10-year bonds, right? And it's fine. That's an approach. I mean, listen, we all know, in fact, even a better example that young people may know of, Warren Buffett. So people think about Warren Buffett as a very successful investor, and he is. I mean, he's been really successful. Now, the question is, does that mean that since he was so successful, that any discretionary manager will be successful? Obviously not. Likewise, if there are some successful quant managers, that doesn't mean that they're all good. So one thing I can say, having done this for about 22 years, is there is a big random component in outcomes in this profession. Once again, to go back to the theme of what you're trying to do, which I think is really important, I think that one should do this because they feel that this is exciting. Financial success hopefully will follow, but there is a big component of good luck. In other words, like it or not, no matter how good you are, performance matters a lot. And so, some people are incredibly smart and they start with difficult performance and never have the opportunity to recover from that. And vice versa, some people who are not necessarily at the top in terms of creativity, but they have done some very good trades, and that creates a path of great financial success. Now, don't get me wrong, I'm not here to say that money doesn't matter, financial success doesn't, but I would not make a decision on my career ever just based on that.